on the customer, the need to have sales and marketing look into the same direction has become more critical than ever. So Jonan, I'll end here on emerging trends. I hope we can move, that could be sufficient to move into the Q&As.
Thank you so much, Donato.
I would have loved to continue.
I know. And thank you for moving to the right building, because previously, from your background, we had challenges. But today, I'm sure you must have simply changed the location in terms of which building you can be at. So I'll just go into the Q&A very fast. We have a couple of questions here, which I want you to handle. I know that you would want to just be away very briefly, and then you return later, but at least first handle these questions. Now, you said that marketing is about identifying, anticipating, and satisfying customer needs. Yes. Our participants would want to know, how do I identify these needs? How do I even anticipate them? And how do I satisfy? So you see, you've given a definition that has these terminologies, but they want it broken down. What is the process of identifying? How do I identify these needs? How do I satisfy these needs? How do I anticipate them? That's question number one. Question number two, Donato, concerns the sales cycle. Okay? They're asking which stage of the sales cycle is the most important. Which stage of the sales cycle would you consider to be the most crucial for a sales agent? I hope you're getting me loud and clear, Donato, and you're hearing the questions.
Just hold on, I'm trying to take note. The first one is?
Question number one, they want to know how they identify needs of customers, how they can anticipate them, and how they can be able to satisfy. Remember, from your definition, you gave these as key elements of a definition of marketing. But the question is, how do we satisfy these? How do we identify the needs from your experience? The second question regards the sales cycle. And they're asking, what do you consider to be the most crucial stage of the sales cycle to a sales agent? And I think maybe you could be able to combine that with another question around the sales techniques. Again, someone wanted you to sort of, because you know you gave a number of techniques, there's so many.
Yes.
But what are what are the crucial 3 or 5 that I must have as a salesperson to be a professional? Because you know it might not be possible that I will have all the techniques with me, but what are those that are a must? You could combine those two questions. Just take those, and then I will return with another set of questions, and then we can be able to move into the other Q&A session. Participants, please don't move away. You need this information. Our tutors are already online. We are going into the Q&A session. Thank you. Donato, over to you.
Okay, thank you. In terms of the first question, how do you identify, anticipate, and satisfy needs? What is very important to take note of is, because there are broad subjects here that we need to look at. When you talk about identifying needs of the customer, research comes in. You can be deliberate and do a research on a particular area of your business and the customer in the market. Which customers am I targeting? Once I know the customers, maybe you're targeting traders who do import goods from say Dubai and China, and you want to find out what kind of risks do they face. Maybe you want to insure them. You can carry out a research, do a survey, focus on them, and then you can design a research tools that you can use, and then get this information, analyze the information, and out of that information, you'll be able to identify the kind of needs that they have based on the survey that you've carried out. Now, when you come to anticipating is more from experience, is that you can, from interacting with this particular target audience or these customers, you're able to see the characteristics and how they behave, and you're able to combine your knowledge and experience to anticipate the kind of needs they will have. It happens a lot. Most people use anticipation because of their experience and knowledge. They sit and actually say maybe they need this. The other bit is satisfying is, are you able to deliver exactly what the customer needs? If you identify the needs through a survey and discover people who go to Dubai face these challenges in containers, goods are damaged when they are sharing containers, as an example, That is the need you identified. It has been identified, it's done. You design a product that actually covers that particular need. Automatically, you will satisfy the need. I don't know if that makes sense. Once you get the identification right and you design the right product for this actual need that will be identified, automatically you will satisfy the need of the customer should that happen from what you've delivered. Jonan, I would like to submit that.
Thank you so much. Have you dealt with the sales cycle?
I'm coming to the sales cycle. In terms of what is very critical, for me, I shared, I'm not going to share the slide again. Is that okay?
No, it's okay. It's okay. Proceed and respond to the question.
We have the sales, we mentioned the sales cycle, and you wanted me to combine with the
question was, what is the most crucial stage of the sales cycle? And I wanted you to combine that with you highlighting the most important techniques, sales techniques that a salesperson should have. Maybe about three, rank them.
Okay.
I thought they were related questions.
Okay, let me, they're a bit related, but as well different. Let me just talk about the most critical stage. To me, what I would consider very critical is the prospecting. The prospecting, just like you saw the sales funnel, the sales funnel has a shape where you have quantity, a higher quantity of prospects at the top. And then as you come out to the bottom, there are few. Prospecting becomes critical because the quality of your prospecting determines the quality of your closing. You cannot have very good closing if you have poor prospecting. So the rest that happens in the middle is just part of the process. But I believe if you can get your prospecting right, you know you've gotten the right target audience, you've understood them, you've profiled them very well, you know these are the people you need. And these are the people who actually consume my product. Becomes easy for you to walk through the rest. But get the wrong people on board, you spend more work prospecting than actually getting leads that go up to the closing. So for me, that is the most critical part of the sales cycle. The rest will follow, but you know, garbage in, garbage out. That is the metaphor I use. So where the garbage starts is where you should focus. Clean your prospect profiles very well, get them right, understand them in line with your business or what you offer. Automatically, the rest become easy because you get a higher percentage on what you get out. The other bit is in terms of the techniques. When we talk about techniques, first, I'll talk about attitude. Attitude is everything. You fix your attitude. I've seen salespeople who get it right just because of the attitude. He comes in, he doesn't have the right packaging, but he learns how to dress. Those things you can learn. All the rest you can learn. But attitude, man, it is you to fix it. So for me, that is the first step I believe you must really work on, is your attitude. You cannot tell me you're going to sell when you have the wrong attitude. Sometimes people will want to work with guys who have great attitudes. You may not be the best salesperson, but your attitude can get you places. The other bit is product knowledge. Product knowledge, you cannot sell what you don't know. So fix your product knowledge, get the grades, go and do COP if you're new to insurance. Have you taken time to become an expert in your field? You can't go and sell something you're not been designed to sell. Are you the best at insurance? Do you understand what you're selling very well? This motto you're selling, do you understand motto very well? Or you're just trying to masquerade and say, I have motto, you're selling through brochures. My belief is product knowledge is not having the brochure in your folder. Product knowledge is understanding the product, going and studying and becoming an expert in that field. That becomes a critical one. Communication. You know, no one sells insurance without being there in person. We're not selling air tickets. Yeah, air tickets. An air ticket is an air ticket. You see the discount you buy. With insurance, when you have a personal touch, so communication becomes key. You must work on your communication skills to be able to deliver. When you look at the fourth, listening skills, salespeople who don't listen are irritating. I put them in order of what I presented, John, and interestingly, the way the order I presented is how I meant them to be critical. Listening skills.
I totally agree with you.
If you don't listen, You never, I mean, the salespeople will irritate. Before you talk, he's already telling you. You want to explain, he's already suffocating you with words. You will get irritated and say, no, I'll talk to you next week. So listening is critical. You must be able to. I want to close with a fifth. Fifth, unfortunately, the fifth is not what it is in the slides. My fifth, I'm stopping on 5, building relationships. Those top 5 for me are critical. You realize all of them relate to the individual effort as a person. You must be able to apply yourself. Building relationships, you must take the step to build those relationships. You must be a good listener. You must have the right attitude. You must communicate right. You must have the product knowledge. It all goes back to the individuals taking the first step. No one can make a good salesperson without you actually applying it yourself. It must start with you. And the techniques I've touched all touch on an individual effort to actually be a good salesperson. John, and I'll submit there.
Thank you, Donato. Yes. I'll just forward just 2 more questions because we are running out of time. Okay. The first question I've seen here comes from Rema. Rema is very worried that the times are changing and she's wondering how best she can get new clients in the era of online business. Rema is aware of the fact that the times are changing, but she would now want to know how best she can get new clients in the era of online business. How can she position herself to ensure that she can tap into getting new clients using online business or online methods? Now, the other question, yes. The other question, Donato, is, you know, you talked about selling and marketing.
Yes.
And this question is very similar to another one, which talks about the marketing mix. Now, the participants are wondering, how do they use the marketing mix in terms of presenting themselves and not necessarily ensuring that they are simply using these factors to sort of ensure that customers buy. So how is the marketing mix applicable to the salesperson?
Okay.
And also that aspect of marketing, which I think are quite close. So if you can probably respond to those 2, and then we shall move into the next part of the session.
Okay. So I will just allow me to, let me start with the last one.
Yep.
Is that okay?
That's okay.
Okay. So what happened?
In 3 minutes.
Wow. Okay, so the last one, marketing mix application to you as a salesperson. Just like you look at the 7 P's, knowledge is very important. When you're dealing with a customer and you're dealing with it, you want to actually close a sale. The fact that you have knowledge of the product, product knowledge comes in. What product you're selling. When you apply it to yourself, you're now looking at it more from what do I have to offer the customer? Do you know the price of what you're offering the customer? Do you know the alternatives of where the customer can get it? In this case, if you're a salesperson, you're one of the places the customer can get it. Who's your competition as a salesperson? Is it a broker? Is it then I'm losing my battery. Okay, that is good. Is it a broker? Is it a fellow agent? Place tells you. Now, as a salesperson, that's how, when you understand what place is, it becomes applicable for you. The other bit is promotion. What can you do to actually entice the customer to buy? I can do for you as a marketing person, I'll help you communicate and do billboards. I'll do radio adverts. I'll create awareness for you. But I'm not going to come and help you make the personal selling. Personal selling becomes your part. You find that bit comes in for you. What sales promotion can you offer? Do you have some goodies? Can you look after the customer? What can you take for the customer? Can you, birthday messages? What can you do as a salesperson under promotion? When it comes to process, how do you organize yourself as a salesperson? Do you have a register of your leads? There are salespeople who you'll ask, what do you have in your pipeline for next month? And he doesn't know. Honestly, you don't have a book where you list your sales. The process you follow as a salesperson does not differ from the process of the marketing mix. What's the process of you delivering your service? Do you know the process of your business? When I have I need a quotation, who do I go to in the company? You must know the process. How do I get a quotation out of my company? How do I get a client's claim paid? How do I, so it's important to understand the process of your business. The other one is people. Who in the business do I go to when I need maybe an engineering quote? Who do I go to in the business when I need this related risk covered? Who will advise me on this part? So it is important for you to understand this in respect to your business and how you come into the picture. Physical evidence. Do you have business cards? You can't come and tell Donato, I am from this company and I sell insurance, and you leave me without anything to remember you. You've talked about the service, but I don't know the service. You can't keep the product with me on the table and go. So you must understand these elements and how they relate to in context of your business and yourself in terms of what you do for the business. I hope that addresses it. The other bit of marketing broadly, the fact that now when you talk about marketing, you're talking about more around the customer. You get the difference. With selling, you're talking about the product and what the solution you're selling. The fact that you start focusing on marketing in terms of the customer, automatically marketing starts to play a part in the selling process. Your discussion is around understanding the customer more. That is already marketing. I can tell you, go to Jonan, he works here, and just take him this proposal. And then convince him. You'll go and meet Jonan and just sell to Jonan, because I've already profiled Jonan for you. That is the target audience for this particular product. So the selling comes in, you're going to close the sale. I've already given you target audience, told you who he is, where he is, and what to sell to him. The marketing part is done. Now, in this case, as a salesperson, you're starting from where I've started. You start by understanding the target audience, profile the target audience, understand their needs, then now go out and sell to them. That is now broadly how the marketing element comes in, because of the focus on the customer. The one who's looking for leads online, things have changed, things are very tough. How do you get leads? It's about your positioning as a person online. How do you come off as a person online? Platforms like LinkedIn, Facebook, Twitter, there are so many. You cannot, basically, you cannot just leave. The number of people are different on who they are, with who they are online. I mean, you must have a presence. What presence do you have online? What are you doing online? Are you just supporting soccer, posting all stupid videos that are there? Or are you trying to position yourself as an authority in your field? Are you on LinkedIn and being an opinion figure on LinkedIn? Or you're just there laughing at everything that comes that is funny? So you must go into these platforms and have a strategy of how you position yourself. One, LinkedIn is a professional site. Have a profile there. And let it be clear that you sell insurance. Identify customers who are in Uganda. Look for companies that are selling cars. Write to them, reach out to them. Everybody's marketing a business online. Look for them. Make yourself relevant online. And then you'll be able to tap into businesses online. But you can't be there and just teething away online and you expect that customers will see you. I think it's what you use the platform for that matters.
I think, Donato, you've handled those questions very well. Thank you so much. We now must move to the next phase of the Q&A session. Yes. Thank you for taking off time to be with us. Wonderful presentation, wonderful responses to our questions. The questions are still coming in, but we shall be able then to save these and share them with you and also with our participants later on. Yes. Now, I need to remind you that the session is being recorded. Yes. And definitely will be available for download on our website, on the ITC website, www.itc.ac.ug. So, Ronnie, I just want to be sure that all my tutors are on and they can hear me loud and clear. Allow me to welcome Mr. Joshua Akena. Mr. Joshua Akena, can you respond that you're online?
Yes, Jonathan, I'm on. Yeah, good morning, everyone.
Yes.
Yes, I'm
That's
on.
Wonderful. Joshua, be on standby because now we are going into the Q&A. Joshua is our trainer for life and pensions business. Now, Mr. Batanda, Ronald, are you online? Kindly confirm, please. Ronnie Batanda. Mr. Balimunsi, you need to unmute our tutors because I need to just give a bit of house rules in terms of how we are going to handle that Q&A session.
Yeah, Batanda is on.
Well, I need confirmation from his side that he's on and he can hear me loud and clear, and that our participants can also hear him.
Maybe Silva.
Rokani, are you on?
Yes, I am on.
Perfect. Rokani is on. Ronnie Batanda, Ronald Batanda, can I have some sort of signal from your side that you're on? Any sort of sign? Okay, I know Mr. Bashabe is also on. So this is what we are going to do for the Q&A session. Thank you so much for joining us, ladies and gentlemen, for the Q&A session. We said it would run from 10 to midday. I see Mr. Bashabe is on.
So this is what is
going to happen during this session. I will be reading out the questions that you've sent through and directing them to the appropriate facilitator who will then be able to handle these questions. Now, these sessions are not going to be completely divided in such a way that we'll start with one section or one subject matter and then go into another, but it will be a mix. And it's very, very important that all our participants stay put because we need this information, we need this knowledge. You may be selling or you may be in a life company, but I am sure you also need to compare with general insurance or non-life. You could be probably in a non-life company. You may want to understand a few concepts around bank assurance that apply to you in terms of non-life or life. So I'll just then simply be going into the questions and then our tutors will be taking this on. Ronnie, you assured me that Batanda is online.
Yes.
And I would want confirmation from that side that he is. We'll start with Joshua. Joshua, these questions are going out to you. Now, our dear trainers, once you've completed responding to the question, please inform us that you've submitted or use the word I submit as a signal that we can then move into the next set of questions. Because we don't want to cut you short where you're still giving an explanation. And that is how we shall move forward. Now, Joshua, the first set of questions are to you, and our participants are saying they would want you to identify the different types of policies that apply to the different scenarios below. We have got Kenneth, who took out a policy where the benefit will be paid only on death, but the policy earns bonuses at the end of every year. So what policy is applicable to Kenneth? These are scenarios, and you need to assist us by giving reasons why you think that policy is applicable to that particular client. The second scenario is of Andrew, who has acquired a policy which would provide him income in the event of total disability. What sort of policy is applicable to Andrew and why? You need to give us those reasons. We also have Jocelyn, who has taken out a policy to ensure no interruption in her child's education, and the policy will expire when she expects the child to have completed school. Again, you will also give us the dynamics around that policy and why you think that is the particular policy that Jocelyn has taken out. The last section of that scenario is which benefits would you receive at the end of the 5th year if the policy you bought expires after 5 years? Mr. Akena, I would want to bring you in at this moment. Unless the questions are not clear and you want me to rephrase, please proceed. Over to you, Joshua. Joshua, are you with us?
Okay, yeah, I'm there now. Thank you, Jonathan. The questions are very clear. I'll start with the first scenario. Someone asked us if Kenneth took out a policy and where the benefit will be paid only at death, and then earns bonuses at the end of the period, what policy would he actually take? I would approach it in two ways. One is that the aspect that Kenneth takes a policy which provides a benefit only payable on death would imply two key policies apply there from what we discussed last time. The first would be a term assurance policy, and we say the term assurance policy is a typical protection policy covering death during the term of the policy. You could take a particular type of term assurance policy, maybe a key man assurance, for example, if he's a key person in the business. But also, too, he could also be involved in maybe an occupation which is risky, assuming if I got a job and I'm working in a risky environment, maybe for a contract, maybe 3-4 years, and I think my biggest risk during this period could be death, I could still buy that policy. So the first one would be a term assurance. The other policy also you could take would be a whole life policy. The whole life policy also covers us, especially against the risk of death. So that's number two. In answering maybe the second segment of the question, it says that the policy would provide benefits at the end of the year. So that would imply that, and you know very well that term assurance policies are not with profit policies. So automatically term assurance will not qualify for bonuses. The only one which would qualify for bonuses would be the whole life. So we have what we call whole life with profit policies, whereby the client participates in the profitability of the company. I think that would be my approach for the first question. The second one, that is, I think, you talked about Andrew. So Andrew has acquired a policy. He wants a policy which would give him income in case of total disability. Of course, the most appropriate policy there would be an income protection policy. And an income protection policy is a policy taken out to cover you against a loss of income, especially against total permanent disability. Though it's not so common in our market, so the other option would do is that most of the policies sold on our market, the endowments, even the term assurance policies, they have a rider benefit of permanent total disability. So you can still buy the normal policies we have in the market, the endowments, term assurance policies. However, the policy will have to have a rider benefit. Remember, we said riders additional benefits onto the policy. So the rider benefit would be permanent total incapacity, which would cover him, especially if he gets totally permanent disabled. That benefit would be paid to him or paid to him. So that's the approach I would use for the second part. The third question, I think you talked about Jocelyn. So Jocelyn takes out a policy to ensure that there is no interruption in her child's education after a period of time, and she wants this policy to expire, especially when a child has completed school. Of course, this is a typical endowment policy. I remember I said that endowment policies have two common aspects of protection and also savings. And in particular, the applicable endowment policy will be a children's education policy. Very common in the market. I think all life companies are offering that. And you buy this policy to help guarantee the education of your child. Because if as a parent I passed away during the term of the policy, the future, my plan to ensure that my child had a quality guaranteed education is still maintained. If my policy still at the end of the period, the sum assured is still paid. In case of loss of the parent, the sum assured can even be paid installments agreed either to the school or to the family or to the estate. So it would basically be a children's education policy, which is basically an application of the endowment policy in terms of classification of a life insurance product. Of course, the policy will participate in bonuses. If it's an endowment, it definitely participates in bonuses annually, what you call reversionary bonuses. Basically, each year a percentage of the sum assured will be paid after valuation of a life fund. So that's basically a typical application of endowment, which would be a children's education policy. I think the fourth question raised states was by one person. Jonah just highlighted that what benefits would someone get, especially at the end of the 5th year, assuming their policy expires after 5 years. Whenever you talk about expiry of policies, what basically has to come into your mind, these are basically term assurance policies. So we say term assurance policies expire, whereas typical savings products do mature, products like the endowments. So since this policy expires at the end of the 5th year, automatically what that means is that if provided I'm alive at the end of the period, no benefit is payable. That's a typical application of a term assurance policy. Typically, so no benefit is payable once the policy matures. Maybe, however, if it was a maturity benefit policy like endowment, of course the maturity benefit will be payable. But if a policy expires, basically these are term assurance policies that once say to expire, no benefit will be payable, because the purpose of the purpose as to why you took the policy during the term would have already been made. For example, if I took a loan, if my loan was to run for 5 years, so it's expected that after 5 years, maybe the outstanding loan balance has reduced. So the purpose of the policy would have been met. I think, Jonathan, those were, I think, the first 4 questions which you addressed to me.
Thank you so much, Joshua. And allow me now to move to Rokani. Rokani, you'll take 2 questions before we then move into Ronnie Batanda, and then finally to Mr. Bashabe. Now, Rokani, I hope you can hear me loud and clear.
Yes, I can hear you.
There is a question here regarding what challenges is the bank assurance sector facing in Uganda today. Rokani, you're a practitioner. Our participants would want to know what challenges you're facing today in terms of bank assurance.
Okay.
That is the first question. The second question is, in Uganda, which bank assurance models are being used and which is the most successful model? I know in your session on Friday morning, you took us through the different bank assurance models. Our participants would want to know what models are we using in Uganda and which of those has been the most successful. I hope those questions are clear, Sylvester, and I would like to invite you now to respond to our participants.
Okay, thank you very much, Jonan. I hope everyone can hear me. I'll quickly deal with the challenges of bank assurance. Now, one of the most important and passionate challenges that we're actually facing now is in terms of knowledge. And that is knowledge of the specified persons who are actually supposed to distribute these products or speak to our customers about these products to the customers. So it is an entirely new concept to some of these people. So the knowledge gap is quite profound, and we are very glad that the Insurance Institute has partnered with most of the banks to actually speed up the knowledge gap by actually coming up with COP and CIU, those fast-tracked courses for 2 weeks. So that is one of the biggest challenges now. The other challenge is data protection and data privacy. Because we are dealing with external parties, who in this case are the insurance companies, we've seen sometimes the information that we send over to these insurance companies about some of our customers sometimes is actually misused. So we're losing trust for our customers. If you send information to an insurance company for a different purpose, but the customer's contact is gotten and contacted for something other than what you have requested for. So customers are actually skeptical about that. Another of the challenges that we are actually having today is some unethical practices by some of the advisors, both on the bank side and the insurer's side. Now, we must understand that because of the pressures that some of these people have, especially the sales people, they are going to go to certain lengths to actually be able to close a sale. And that may be either not telling a customer all the information about a product, or telling a customer to omit certain information which they know is material to that particular product. So that is also one of the challenges that we are actually facing on the bancassurance side. Another challenge that we are facing is the threat or the constant bickering between the bancassurance agents and the other intermediaries. So other intermediaries are looking at the bancassurance distribution channel as a threat to their business. They're looking at bancassurance as poaching on some of their customers, and which is actually making them lose a bit of their business. So what we have seen happen is that it's not healthy competition between some of the other intermediaries in the insurance sector. But what we are trying to promote and trying to show these other intermediaries that the bancassurance channel is there to actually enhance competition rather than competition between these different intermediaries. So all the agents and the brokers have a specific and different role and something different that they can actually bring to the party. And we are encouraging the other intermediaries to actually work together with the bancassurance agencies to actually make sure that this is not viewed as competition and a threat to each other. Now, the other challenge that we have seen, but this is now actually being handled, is the issue of executive support. When the bancassurance business had just started, that was late 2017 and the early 2018, what the banks were actually just doing is signing onto bancassurance, and then they would leave pretty much the principal officers and the specified people to actually run with the whole concept without giving them much support. So that was a challenge then. We are slowly coming out of this. We are seeing more executive support, and this is mainly because they have actually been able to see the figures of 2018 and 2019, and they're actually seeing what bancassurance can actually bring to the table in terms of insurance, in terms of revenue for the banks. The other challenge that we are actually having is the perception of insurance, especially with our customers, and that is tied towards the penetration of insurance now. Most of our customers actually do appreciate the product, but when you look at their perception of insurance, and of course that comes from history of claims payments and conduct of insurance practitioners, they are actually very skeptical of the entire concept. So that is also a challenge that it takes a long time, most times, to actually convince someone to take on some of these products and also to embrace the whole concept of bancassurance. So from experience, those are some of the challenges that we are facing. Also, just briefly, because the whole concept is new, there are certain regulations that we are grappling with, especially in our operations. One of those is especially has got to do with restriction of selling of the insurance products to actually people who are not bank customers. That is especially hard to deal with, because if you have a referral or someone who walks into your branch, a walk-in, someone who is not your customer and is interested in your products, then you have a catch-22 situation of how to actually deal with that customer. He's not a bank customer, but he's actually interested in the product. So those are some of the challenges that we are grappling with, and we are engaging the regulator on those. Now, when Jonan, the second question is regarding the models. Now, I spoke about models, and there are actually 5 models. Now, to actually say that this model is actually preferred, is quite hard, because what we are seeing is that most of the agents now, the bank assurance agents, that is, are using most likely 3 models concurrently. Now, that is the pure distributor model, referral agency, where the bank will just refer contacts of a customer to an insurance company. The insurance company will follow up that particular customer and try and close that sale and give feedback to the bank. The other model that the bank is actually using is the pure distributor, which is now the corporate agency model, where the bank actually goes a step further to be able to make sure that its staff, the staff and other specified persons who are actually involved in the whole concept of bank assurance are actually knowledgeable and they are selling this product. So that involves training, that involves incentives. So in the corporate agency model, the bank is actually taking a more keener interest, and their participation is actually more in the bank assurance concept. Then the other model that the bank is using is the strategic alliance model. Here, the bank is getting into a specific relationship with an insurance company to undertake either product design or product development, and they are all working on a specific product that would actually be to the benefit of either all the customers in the bank or a specific set of customers. Now, what I have seen, especially with the level where we have reached of bank assurance now, we are just into our 3rd year. These 3 models are actually being used concurrently by most of the banks, but the most common is actually the corporate agency model, where the bank is involving their staff, they are training them, they are incentivizing them, they are linking them up with the insurance companies. So there's a lot of involvement by the banks in that particular model now. So the most common now is the corporate agency model by the banks, but some other models like the pure distributor and the strategic alliance are actually also being used for specific products. John and I submit on the 2 questions that were actually.
Thank you so much, Lokani. I think what you're telling us is that you as practitioners, you're picking the other good things from the other models and then applying them onto the corporate agency model.
Yes, absolutely.
It's a sort of mix.
Yes.
Thank you so much. I would want to now proceed with fundamentals. Mr. Batanda is already online. And I would want to say thank you again, our participants, for staying on with us. Like I mentioned, we will be handling the questions concurrently. We're not dedicating any particular time for a particular subject matter, but we just be handling these concurrently as they come in. Now, allow me to bring in Mr. Ronald Batanda, who is already online. Mr. Ronald Batanda, I'll forward 2 questions, and once you've completed, you will then inform me that you submit, so that I do not in any way interrupt you or cut you short in case you're still explaining to our participants. Now, the first question is, how can insurance companies work together to grow insurance penetration in Uganda? I think what the participant is alluding to is, what are those areas of cooperation? Because yes, it's a business, we are competing, but what is it that we can do together as insurance companies or insurers in order to grow the insurance penetration rate? That's the first question. Now, the second question, again, is around regulation and the approaches to supervision. So which method or approach is currently being used by the Insurance Regulatory Authority of Uganda to supervise insurance companies? Mr. Batanda, I hope you can hear me loud and clear and that the questions are also clear.
Yes, I can hear you, John. I confirm.
You seem to be breaking.
I confirm, I can hear you.
Okay, proceed.
I can proceed. Thank you everyone who's online, and thank you for this opportunity for the ITC and the various participants for participating in this Q&A. I will hope I'm audible enough. I'll go into the very first question that relates to how insurance companies can be able to increase on cooperation and penetration of insurance. I think at the end of the day, I would pick out 3 key points. I think first and foremost is that what we need to understand is that we have a market that is quite broad in terms of opportunities. We have various untapped sectors that we can be able to access. Currently, of course, the biggest challenge is that we all fight for the same piece of cake, which are our typical corporate businesses that are within our own reach. While that is good, it does not necessarily bring about what we call sustainable growth. There could be some bit of organic growth because maybe organizations are purchasing probably more premises, they're probably hiring more people, which in insurance, of course, we term as basically organic growth, basically. But in terms of sustainable growth, we need to start looking into other sectors that are literally untapped. And of course, we do have a number of players that have ventured into areas like microinsurance, but there are virgin areas, the key risks that actually face the population that we actually need to focus on. And focus on means that we need to invest in terms of in terms of resources, in terms of research, in terms of being able to understand the different dynamics, because we don't want to be caught in a scenario where we do what we call product development at your desk, where you come up with ideas with a team of people at the desk, but you need to be able to go out there to understand how these products impact on the final consumer, how the relevance of these products. So as insurance companies, there's a need for synergies in areas of being able to understand at what point are we leveraging on our, for instance, on our technology. For instance, I give an issue to do with fraud. Fraud absolutely affects quite a number of companies in different ways and may affect final insurance pricing. But then the key issue is how do we work together, of course, with support from the IRA, which has the anti-fraud desk, but how do we then work together to be able to mitigate leakages related to fraud? Because at the end of the day, it affects the pricing of insurance, which would affect the affordability of insurance. So that is something that needs to be looked at. And then also from a product development point of view, I think there's more need for us to invest more in terms of understanding our products, in terms of simplification of the products. Many clients receive policies, but probably they could have ambiguities at the end of the day, or they could have areas that probably don't address the concerns of clients. So I think at the end of the day, in issues of how our products are designed, packaged, if you look at, if we shift very quickly to the marketing piece, if you're looking at place, if you're looking at price, if you're looking at partnerships, right? All these do eventually play a very, very critical role on how our product and service is enjoyed. Because at the end of the day, what we believe in is that clients, we will purchase insurance products. I believe so. But I think what's very critical at the end of the day is the experience. What experience do they go through at the end of the day to be able to be able to enjoy this service? And I think we are still developing. We are still trying to assess and be better at this. But we need to perfect it sooner than later, so that we can be able to have more people on board to understand how insurance plays a critical role, both for the individual, the society, and the economy as a whole, basically. And that has to come out quite strongly. And then the third issue in terms of what would help on penetration and also the growth of insurance generally is us being able to focus predominantly on the role of it is split. One is to understand the role of regulation in terms of what has been set forth by our regulators. How are we able to align ourselves and our regulators? But most importantly, also are issues to do with corporate governance, which is not so far away from what I've just said. How are companies running? How do shareholders liaise with the board, and the board with the management, and the management with the employees? Do people get a buy-in eventually from a bottom-up pyramid, just to say it's from that argument? Because at the end of the day, what we believe cascading of how companies operates is a top-down approach. At the end of the day, we want the bottom. We want through down the cascade. If you look at it from a strategic point of view, from a tactical point of view, from an operational point of view, have individuals appreciated the different aspects? Do we understand how do we understand the external environment that we operate in? Do we know who our clients are? Do we know the role of the regulator? Who are we working with in terms of our supply? The number of things that we need to embrace. If we look at our internal environment, do we have the right skill sets? Do we have the right people on the ground? So it's looking at the whole ecosystem generally and understanding what to plug in to be able to support the industry. So that would be my first response in regard to the issues of penetration. And then in regard to question 2, in terms of how the IRA's approach to regulation, I will not speak in terms of speaking as a spokesman for the IRA, but however, I'll share my opinion. It's purely, of course, based on a bit of textbook, but also what we have experienced in the industry. I think the regulation, in my opinion, always translates between what we call rules-based or compliance-based to a bit of principle-based and now risk-based. What we have seen is that typically when most industries are growing, you will find that there's typically a compliance-stroke rules-based environment, which basically means that a number of rules or guidelines in terms that are pretty much cast in stone are provided to give guidance. And the logic behind that is very simple. The logic is that at the end of the day, the industry has to adhere to specific rules so that it's operating in a particular dimension and with a level of clarity. And then as an industry develops and there's a bit of comfort in terms of how the players are joining, the skill set of the management and the employees and the appreciation of insurance, then you get a feel that there will be principle-based supervision that sets in line principles that are to be followed. Principles in their own set are basically the same way you say that probably, I mean, for us who stay in our homes, probably you say that it's a good practice to be home before 7. It is a good practice, is a principle. However, on the contrary, if I say you must be home by 7 o'clock, then that becomes rules-based. But if I say it's a good practice to be home at 7, then becomes a principle. It gives you the leeway. You may reach at 7:30, but there could be justification. So principle-based is basically instituted to allow organizations run in such a way that they could make a bit of leeway based on a number of principles, but the principles are based on good international practice. And then, of course, lastly but not least is what we talked about the last time, risk-based supervision that predominantly focuses on the key risks organizations face and what kind of capital do they have available. And I think capital is one aspect, but there are a number of other aspects that are involved in risk-based supervision. But for the purpose of this conversation, I think I would see a transition from Uganda, where we are basically transitioning from rules-based supervisions to risk-based supervision. That is an ongoing exercise. It takes a bit of time. Countries like Kenya started some years ago. They're still on their way. So it's not something that is saying today we're starting risk-based supervision, and yes, it's a done deal. It is something that takes a bit of time. So that's what I would really want to share with you. And on that, I say submit.
Thank you, Mr. Batanda.
Yes, sir.
Allow me now to bring in Mr. Bashabe Simon, so that we can then conclude the first round of the questions.
Thank you.
Mr. Bashabe, I hope you can hear me. Ronnie, once I hand over to Mr. Bashabe, you will therefore allow him to respond to the questions. Now, Mr. Bashabe, we have the first question. Provide examples of insurance covers where proposal forms may not be required and give reasons why. And this is specific around general insurance or non-life insurance. What are some of those insurance covers where proposal forms? I know you talked about proposal forms and the importance of completing a proposal form and also the client attesting to the proposal form. But which are those policies where we do not require a proposal form and why? That's the first question. The second question is, what must an underwriter really look out for when underwriting a risk presented? What must an underwriter really look out for? We talk about the aspect of underwriting, accepting and or not accepting, and then therefore rating a risk when it is presented. But what must an underwriter really look out for when underwriting a risk? I think this is a bit specific, and you probably answer it specifically. It is not very, sorry, it's very specific, so you'll also respond to it maybe generally. But I know that different classes would require different underwriting considerations. So over to you, Mr. Bashabe. Please respond to those questions.
Thanks, Jonan, and our dear participants. On the first question, we look at risks which are large and complex. In most cases, risks which are large and complex, here the proposal form will not work best. So we talk of risks like industrial, those falling under industrial risks, say industries. Take an example of Mukwano Industries. If you to insure Mukwano Industries, you cannot use a proposal form. It's a very large and complex risk where a proposal form will not give you all the information that you want to extract. So what do you do? Here you use the services of risk surveyors. So these surveyors will go on the site, on the risk, carry out their assessment and analysis of the risk, come up with a risk survey report, and the information contained in the risk survey report is almost similar to the information that would have been put on the proposal form, but it gives more description of the risk compared to what the proposal form would have given out. So for those large and complex risks where you need more information, assist the underwriter, then the proposal form may not give you all that information. That's why in my presentation, I came out and said that the proposal form is mainly for small risks, or sometimes what we call personal lines, things like motor insurance, domestic insurance, contents insurance, those small risks. But for large and complex, the proposal form may not work out, and we use the services of risk surveyors, or sometimes we use risk notes from the brokers. That's it. Then on point number two, sorry, question number two, where the participant asked what underwriting information would underwriter look out for. As Jonan has said, you see, different risks you're going to underwrite will require different underwriting information. So there is that information which is generic on all risks. For instance, the type of the risks or description, definitely we need to describe maybe the sums insured, that's okay. But for there is that information which is very vital, and that's the specific information. So the specific information that the underwriter will look out for when he's going to underwrite a certain risk will depend on the type or nature of the risk. The underwriting information you require when you're going to underwrite, say, motor insurance is quite different from the information you require when you're going to underwrite a fire insurance. For instance, for a fire insurance, the underwriting information you're looking out for is like the location of the building. You are looking at things like the construction materials of the building. You're looking at things like the fire protective devices within the building you're going to insure, for instance, automatic water sprinklers. You are looking at the surrounding or the neighborhood of the risk you're going to insure. Then when we go back, say, to motor, you're looking at things like the use of the vehicle, the type, the make. The make, is it a truck? Is it a saloon? You know, then you're looking at the experience of the driver. So the information the underwriter requires when he's going to underwrite a certain risk will vary depending on the nature or the type of risk. So different risks have different underwriting requirements. I submit.
Ronnie, allow me to come in.
Thank you so much, Mr. Bashabe. I can see the first round of questions. We've taken about 20 minutes. And if we continue like that, it means we'll have only 2 extra rounds in terms of questions. Now, I would want now to move again to Mr. Akena. Joshua, I hope you can hear me loud and clear.
Yes, I'm there, Jonathan. Yeah.
Okay, perfect. So the next question that comes to you, Joshua, is that which annuity plan would best suit a couple that wants to protect their income on retirement?
Okay.
Which annuity plan would best suit a couple that wants to protect their income on retirement? The next question from a participant, they are saying you as an underwriter, a life assurance underwriter or life insurance underwriter, what are some of the extra risks that you can identify in the underwriting process, and how would you be able to deal with these? This is the question on the extra risks and their treatment. Mr. Akena, I hope the questions are clear, and I would then love to invite you to take on these questions and respond to our participants. Thank you. Meanwhile, Rokani, please be on standby.
Thank you, Jonah, for the questions raised. And thank you, participants, for those 2 brilliant questions. I'll dive into the first one. Someone is asking us about what type of annuity would suit a retired couple, I think, a retired couple. And remember we said the annuity is basically a contracts which we arrange with life companies. And once you're paid your lump sum, the insurance life company guarantees you what you call periodic payments known as annuities monthly. So the most appropriate policy here is what you call, it's basically a last survivor annuity, or what you call, some people call it joint, but basically we say joint because 2 lives are dependent, for example, a husband and wife. However, the type of annuity would be called a last survivor, or what you call first to die. And why this is important for a couple is that couples, remember we had said earlier that they have unlimited interest in each other. And in this case, in case one couple dies, I mean, in case one of the partners dies, if a husband has passed away, annuity payments continue to the surviving spouse. So that is basically the principle. So that's why you call it a last survivor, or first to die, or last to survive. Some people call it that. But it's a joint life policy having factors of underwriting dependent on the spouse and also the husband. I mean, both husband and wife. So the policy there is called a last survivor's annuity. But even if you call it for last survivors joint life annuity, it is still right. Yeah, that's the annuity which will be applicable in that circumstance, such that even if the husband has died, the wife can continue to receive payments for a fixed period of time or guaranteed period of time. So that would be the best policy for a couple that has retired. I think I'll go to the second question in terms of underwriting and what risks are involved in terms of identifying the extra risks, and then how do underwriters deal with those particular risks. You remember we said that underwriting usually is in two stages. The first one is the initial underwriting, whereby we basically use a proposal form. And then the detailed underwriting, we go deep into getting things like medical examination, and then sometimes even questionnaires could be applied, either occupational questionnaires could be used, or even financial questionnaire. But in terms of risks, there are basically mainly three. You remember risk can be categorized, risks for life insurance policies. Once a client has gone for medical examination, the risks are usually classified into four. The first one is what you call a standard risk. So a standard risk, basically, if someone is age 30, the expectation is that as per the mortality rate book, or as per the mortality experience, this person will live for a defined period of time, and so we're able to get a rate. So that's basically a standard risk, a constant risk. So a standard risk. So in this case, if I was charged 100,000 at placement of the when completing the proposal, nothing will charge. It will remain because I meet basically the expectations of the mortality experience of the company. But the second one, which answers this question, is especially when you have a risk which is increasing. A risk which is increasing is so common, especially for chronic cases. Assuming I'm a life assured and I have a particular ailment which is chronic in nature, and you remember how chronics are, they can increase over time. Chronics do increase over time. And because they increase over time, you realize that my risk will be an extra risk. Now, of course, we cannot be able to know this, especially if we have the medical report from the doctor. And usually, insurers will ask for either a report from your general practitioner or the doctor who you usually attend. So maybe my report could indicate that my chronic illness maybe is increasing at a rate of 5% per year or 10% per year. So because of that, the insurance company will load the premium. So if my premium was 100,000, based on the underwriting rules of the company, which is also based on the treaties that they have with reinsurance companies, they could say, if, for example, I have a chronic illness, for example, if it's asthma, maybe load by 5%. And maybe if the asthma is increasing for the last 3 years, or for the last 2 years shows it was increasing, and it's projected that the next 2 years will increase, we would load the premium maybe by 5% or 10%, again, depending on the underwriting rules of the company. The third one is what you call, so that's what an increasing risk is. So the third category is what you call a decreasing risk. Decreasing risk is again common, especially where we say that you're undergoing prognosis. Prognosis basically says that you're undergoing treatment of the disease or the ailment that you have. And because I'm undergoing treatment, my risk definitely is reducing over a period of time. And maybe the medical reports tell us that if they look at Joshua's assessment, maybe the next 2 to 3 years, this risk continues to decrease. So even when I'm, as an underwriter, much as I load the rate, but based on a decreasing rate. So, and it's expected that as time goes, as prognosis goes on, my risk continues to reduce. So that's what you call a decreasing extra risk. And then finally, of course, if we've talked about constant, we've talked about increasing, we've talked about a decreasing, but also we can also have what you call a constant risk. Assuming I have an occupation which is, maybe I work in a mines, I'm going to change my occupation in the next 1 to 3 years. So my risk is going to be constant. And since my risk is constant, even the extra risk which will be loaded down to me will be a constant rate loaded to me. So the load for me, they'll say, for example, if you work in a mining sector, I'll load your premium maybe say by 20% or by 15%. again, depending on the rules of the company. So that's how we treat an increasing risk. Of course, for worst case scenario, if definitely the risk cannot be standard, it usually declined. And there are cases where the insurance company may not be able to cover. And then finally, we can also postpone, especially if you're expecting, and if a lady is, for example, pregnant, we cannot, the policy can't commence now, but we shall defy it to a time T when they've given birth. So that's basically the treatment of extra risks and what they are, but then also how the insurance companies do handle them in terms of companies. And otherwise, Jonathan, I beg to submit. Yeah.
Thank you so much, Joshua, for that response. Like I mentioned, I will now move to Sylvester. Sylvester, you will also take another set of 2 questions. And then after you, we shall move to Mr. Batanda, who will also handle another 2 questions, and eventually bring in Mr. Bashabe for non-life insurance. Now, Sylvester, the question from a participant is, assuming I have an account in the bank which I rarely use. The participant has an account in the bank, they rarely use it, but they maintain a certain amount of money on this account. Now, their money does not earn any interest, but I will take it that as practices from the side of banking, you will also be deducting your bank charges. So the money does not earn any interest. What bank insurance product would best benefit me and why? So I think this participant now would want to sort of see how to identify a product they can be able to then give to their customer who maintains a certain amount of money on their account but does not earn any interest. Now, the next question is, remember you also told us that bank assurance is a partnership between the bank and the insurance company. But at the end of the day, the risk sits with the insurance company. So the question is, how are complaints handled between bank customers and the insurance company, given that this risk sits on the side of the insurer? So how are complaints from bank customers on insurance products handled between the bank and insurance company? I hope those questions are clear, Sylvester. You can please proceed and respond.
Okay, thank you, Jonan. The questions are loud and clear. I will start with the question of a product that a customer who has a certain amount of money on their account, something that a specified person or someone would like to interest the customer in. Now, the concern of the customer in this particular case is interest, because he has a certain amount of money that is sitting on his account and is not earning an interest. And there are no other benefits that are accruing to that particular customer that can be spoken about. So the product that actually comes to mind is an endowment policy for this particular customer, where for a specific period of time, the customer can sign up for a policy where a specific amount of money will be deducted off their account for a specified period of time. The minimum period in this case would be maybe 5 years. And after the 5-year period, the customer would be able to get, first of all, their savings, the amount of money that they have actually put away, and then also an interest component on top of that. So much as you're saving maybe 100,000 for a certain period, you would also get an interest amount on the total amount that you have saved for that particular period. And then not only that, the customer would also be able to get a certain amount of life assurance for their particular savings. For example, if you are saving maybe 150,000 and your sum assured, which is calculated by the insurance company, is maybe, let's say, 15 million shillings at the end of the period. So in as much as you are saving that amount of money, you also have an assurance of life cover that in the event that you pass away or you are totally and permanently disabled, then the insurance company can actually be able to come in and pay your estate or yourself in case you're disabled a certain amount of money. So this is the first product that actually springs to mind for a customer who has a certain amount of money. So you can save while earning an interest and also have a benefit of insurance onto that. There are also other products that the customer can be able to get, because there are certain insurance products that are tied to certain accounts. For example, you could sign up for, let's say, personal accident cover on your account. You could sign up for personal accident cover, or if it is a homeowners, you could actually sign up for let's say homeowners and content cover on for your house or for your home contents. So that the product that you can actually look at will actually depend on what the bank has on their shelf. But specifically, what comes to mind is an endowment policy for an individual, which would be able to have savings, an interest component, and also a benefit of insurance, specifically protection. Now, on to the second question, Jonan, which was about complaints. Now, the bank is very, very particular about their reputation, and they take complaints handling and customer feedback very, very, very seriously. There's a fully fledged department that actually handles that. Now, as soon as someone has a complaint, the first step that is undertaken in the bank is to actually record that complaint. The record is both physical and electronic. So there is a record of every particular complaint that someone actually does have. This is good for feedback. This is good for follow-up. And once that record is in place, then that contact or that complaint is given a tracking number. So someone can actually track where that particular complaint is. So that is the first step in complaints in handling in the bancassurance agents, is to record and track those particular complaints, both electronically and physically. Then the next step that usually happens is to contact the customer and get full details of the complaint. Usually the customer will either write an email or call in or write in a feedback book in the branch and say, I have a complaint about this particular product or this particular kind of service. So the next step will be for an insurance specified person or the principal officer to get in touch with that particular customer and get other details about the complaint, what the complaint is about. And that will give an insight on who should be actually tasked to solve that complaint. In as much as the complaint may be about insurance, it could be that the complaint can be solved on the side of the bank without actually having to go to the insurance company. It could be something to do with deductions on the account, or something else that involves the banking side. So that is important to actually get the details of the complaint, and then also to assure the customer that this is actually being worked on. And then also an important step in a complaint solution process is actually when we are signing agency agreements with the insurers, we actually have service level agreements embedded in those. So there is a specific timeline that we have with these insurance companies to actually solve those complaints. So we have got to ensure that these timelines are followed, and we give the customer that feedback that we will get back to you, or we will solve your complaint within this particular period. So that is very important. So then we'll actually move on to, once we have gotten the details of the complaint, then we'll actually move on to understand either internally or with the insurance company what could have actually happened to actually cause this shortcoming or cause the complaint by the customer. When that is solved, then we will actually give feedback to the customer on the closure of the complaint, or give feedback why that particular complaint actually arose, and make sure we close the complaint. But sometimes, especially with the knowledge and the perception of insurance, there are certain complaints which would actually come to either to the bank or to the insurance company, which the customer will feel either the bank or the insurance company has actually not handled well. So we also explain to the customer the reason why we cannot help them with their particular complaint, and give them other alternative channels of escalation of that particular complaint. That channel would then be, if they want to speak to the insurer directly, then we can give them the insurer's channel. If they are dissatisfied with the process of the insurer or the bank, then we still refer them to the regulator. This could be the insurance regulator or the banking regulator. Now, these complaints which we actually then refer could be product related. It could be related to the product itself, where the policy, for example, in non-life insurance, the policy has expired. The customer has not had a claim, but is demanding that they actually, the bank or the insurance company refunds them their premium because they haven't had a claim. Or it could be related to a life insurance product, where after someone signs up for maybe 1 year and the surrender period has not reached, and they actually want to withdraw their money. So some of those complaints which are related to the product, if we are not able to handle between the bank and the insurance company, and the customer is dissatisfied, then we forward them to channels of the regulator. I submit, John.
Thank you so much, Sylvester, for ably handling those questions. Actually, you've given us a lot of details, which are very, very important. Now, let me bring in Ronnie Batanda. And Ronnie, of course, you will handle these questions very fast, because we need to do one extra round and then be able to close the session. We have only 20 minutes to the top of the hour, so we would ask that we use this time properly. Now, Ronnie, your first question is, what should a sales agent do if they found out that at the time of helping a client during the claims process, they discover that the risk was also covered by another insurer? So your client presents a claim which you're handling as an intermediary, but then in the process of assisting your client, you discover that the same risk was covered by another insurer. What should then a sales agent do in that scenario? Now, the next question is, the participant would want you to use examples in terms of explaining the roles of service providers. I know you mentioned in the market, we have a number of, in the insurance market, we have a number of participants. Some of those are service providers. So the participants want you to use examples where you would require, for example, a doctor, and I know Joshua touched this in medical underwriting, for example, but also I would require the police, the garages, the lawyers as our service providers. So Ronnie, you will take on these questions very fast. I need to remind my facilitators that in case you need to supplement, please feel free to let me know so that you can then be able to supplement on any submission made by another facilitator. So Ronnie, over to you.
Okay, thank you, Jonan. Thank you everyone participating. Hope you can hear me quite well. Very quickly on the issue of being able to find out if while managing a claim, you discover that your client probably has a different policy with a different insurance company. I think this goes down to the principles of insurance, and I focus so much on these principles because in one way or another they're interlinked. And I think what is important for us to understand is besides the very important topic of ethics in insurance, which all my colleagues have spoken about, the principle of utmost good faith requires, at the end of the day, for lack of a better word, I wouldn't want to stick to the narrative of the definition, but it requires us that we reveal information pre-post policy running, or pre-policy running, during the policy, or even after the policy, in case it's up for due for renewal. So this information is important to be shared with the insurance company, because then there automatically there could be two things. One is that what would be the right way to do it from an underwriting perspective or from a claims perspective is then to apply the principle of contribution. So at the end of the day, the different insurance players that are insuring this property would ideally come in to contribute their respective shares based on what has been insured. However, just to take note of this, that while that seems to be textbook related in terms of response, you need to know that for the principle of contribution to apply, there are a number of circumstances that need to be running at the same time. For instance, you need to make sure that it's the same subject matter, it's the same duration of insurance, it's the same time period. So there are a number of dynamics involved. But what's important also to know is what is the motivation for a client having taken out different insurance policies with different insurers. And this is a question that we need to understand from a client's perspective. What insurers basically are trying to prevent in the end of the day is what we call probably double recovery. Double recovery would probably lead to the possibility that a client is recovering more than once. However, what's also important is that at the end of the day, the client actually gets compensated for actually what they actually provided for, and nothing more than that. So the number of complexities around, but remember at the end of the day, this mainly applies for general policies. For personal accident policies, you could have as many as you wish. That's basically for life policies. So that is something to be taken note of. So there are a number of dimensions around that question. And then the other question was to do with the role of the different service providers in regard to how they are playing to the ecosystem of insurance. And here we talk about doctors, we talk about the police, we talk about the loss assessors, surveyors, people who provide actuarial services. These play different roles. For instance, in the nearest of example, with of course, in the interest of time, for instance, for the police, they do provide police reports in case you have had an accident. Some of these are requirements that are required. If you move very quickly and you look at loss assessors, usually they're looking at issues to do with assessment of the risk. They do sometimes provide preliminary reports when an accident has actually happened. You understand? If you moved to the actuarial support, you're looking at the actuary providing you with mathematical predictions, best whether it's on experience, on history, so they're able to help in guidance of setting premium rates, especially for life companies. So this ecosystem, for instance, of course, doctors do a lot. For instance, under group personal accident, they do provide what we call personal incapacity levels, which is basically at what level have you been permanently incapacitated. So these reports are used by insurance companies to be able to determine what next to do. Risk surveyors basically go to sites to understand what kind of risk is involved, what parameters are there to mitigate on risk, what factors has a client put in place to manage risk, basically. So they provide a holistic view. But in a nutshell, service providers exist to support the role of the insurer in basically appreciating the risk, but also making sure they've put the right pricing and the right conditions and warranties, if any, to make sure that the risk they bring on board is well priced, and also it applies to the pool it has been brought in. I submit, Jonan.
Thank you so much, Ronnie Batanda. I want to bring in Mr. Bashabe very fast. It is just 13 minutes to the top of the hour. and we're supposed to be out of here at midday. So Mr. Bashabe, you'll quickly take on these questions, and then I will guide how we shall be able to conclude. Now, the first question is, using an example, Mr. Bashabe, try and explain what it means for an insured to reinstate the sum insured of a policy after loss. I think here they're just bringing in the aspect of the reinstatement clause. Mr. Bashabe, try and throw some light on that aspect for our participants to understand clearly. Then the other question regards computing of premium. When computing the adequate premium to be paid in a policy, which fees do we put into consideration? So ideally, to a client, what constitutes the premium? What are the other factors that come in when you're computing premium, Mr. Bashabe? Over to you.
Yes.
Ronnie, you need to, okay, thank you.
Thanks so much, Jonan. Question number 1 is on restatements of sums insured. When do we have restatements of sums insured? This happens when you register a series of successive personal claim payments. I can best bring out this using an example with an indemnity limit of 100 million. Now, this cover was underwritten on 1st of January, say 2019. Now, on the first of the claim, and is paid, say, 30 million. Then after that, the cover continues. Say in February, end of February, he or she registered another claim. Then he's paid 60 million. So you note that in January, a claim was registered, he was paid 30 million. In Feb, a claim registered is paid 60 million. So meaning that he has already claimed 90 million. And the cover, his public liability cover he had taken has a limit, and in Feb, he still has 10 months to go, but he has already claimed 90 million. So he's only having 10 million. His policy is only remaining with 10 million. Yet he still has 10 months to go. Having 10 million and remaining with 10 months. So supposing something happens along the way. So for this client to be safe and not exposed, he will go back to the insurer and say, I want to reinstate my sums insured back to 100 million. So, and now we will take, charge, because the client has used 90 million. So to reinstate him back to 100 million, he needs to reinstate 90 million. So he's going to come up with a premium, restatement premium, or maybe we can call them pro rata premiums for the 90 million. Then when the client agrees to pay that, then the client will be reinstated back to 100 million. So meaning now, after agreement of reinstatement premiums, the client limits of indemnity goes back to 100 million. So the sums insured are reinstated to 100 million and the client is fully covered. That is a restatement of sums insured. Then on the second question, the participant wants to know what are other charges, if the client is paying premiums, what are the charges included? The first charge, of course, we come up with and which guides us is the basic premium, the premium that belongs to the insurer. And how do we come up with the basic premiums? We get the sums insured multiplied by we multiply it with premium rate depending on the type of cover. So when we do that, we get the base premium. The premium is belonging to the insurer. This is where the claims will be paid, salaries will be paid, and other operational costs, the base premium. Then when we are done with base premiums, we come up with other charges which the participant, I think, was interested in to know. So these other charges, we look at charges like sticker fees, we look at charges, stamp duty, we look at charges like VAT, value added tax, then we look at the training levy. So you get the base premium, add on those other charges, then come up with the gross premium. But what is very important here, and where we are teaching Goro is on calculation of value added tax, VAT. When you calculating VAT, you consider, you apply it on basic premium, sticker fees, and training levy. The sticker fees and training levy must be included when you try to come up with a VAT. So once added, then you come up with a gross premiums or total premiums which are supposed to be paid by the client. Yeah, that's it. I submit.
Ronnie, can you allow me to come in?
I need to come in. Okay, thank you so much, Bash. We have only 5 minutes, and I will then just forward just a single question, which our facilitators will handle, and then I will come in and close. Now, you need, our dear facilitators, please listen carefully, because I'm going to then allocate the questions once, and we will then move in that very order in terms of responding. Sylvester, there's a question here in terms of how many regulators we have for bank assurance. Please guide our participants in terms of how many regulators we have in the bank assurance space. Sylvester, I'll also request that when you finish submitting that question, you give your closing remark. So for each one of you, I'll just simply give 2 minutes to respond. So Sylvester will go first. Next will be Mr. Bashabe. The question is, what is the most commonly sold or bought insurance product in Uganda and why? So again, you'll also give your closing remarks. Now, Mr. Akena, there's an interesting question here on how life funds are invested. So how are life funds invested, and what are the guidelines in terms of investing these funds that we receive as life insurance companies? Ronnie Batanda, there is a scenario here which will help us with in terms of an accident involving a boda who is knocked by an insured motor vehicle that causes death to the boda. But on investigation, it is discovered that ideally the boda made a wrong turn. So how would that claim be handled? Would that be looked into in terms of compensation for the boda rider, and in terms of the third party property damage? You let us know. But also, I'll request Mr. Batanda and also Joshua, as you close, there is also another very interesting scenario where there is an issue of a claim that has been intimated, the claim that has been reported to either a life or general insurer, but there is no documentation accompanying that claim for a period of time. So how long does it take before you can close that claim and it does not become payable anymore? So what is the limitation period in terms of claims where we've not received full documentation? I hope those are clear questions, my dear tutors, facilitators. We have Rokani first, we will have then Mr. Bashabe, we will then have Mr. Batanda, Joshua coming in, and then finally Mr. Batanda. Please, you give your concluding remarks, 1 minute each. Thank you.
Okay, thank you, Jonan. Your question was regarding the regulators. Now, in bank assurance, we have dual regulation. There's a regulator on the banking side. Who is,
I don't know, Rokani, are you on?
Yes, I am on.
Sylvester?
Yes, I am on. Can you hear me?
Am I clear?
Yes, I can hear you.
Okay. I hope all the questions were clear for the facilitators.
Loud and
So
clear.
Sylvester, proceed, please.
Okay. The regulators in bank assurance, two. We have the central bank, which regulates on the side of the bank, and then the insurance regulator, insurance regulatory authority, which regulates insurance matters. The key role that these two actually play is mainly licensing, supervision, and regulation. So without the central bank's license, without the no objection by the central bank, then you cannot actually be licensed by the IRA to be a bank assurance agent. And then the regulator who actually plays the most active role on bank assurance is the insurance regulator, the insurance regulatory authority, who actually come in to not only license and regulate, but also supervise. They are involved in the authorization of the principal officer and the specified persons. They are involved in the authorization of the agency agreements that the bank assurance agent signs with different insurance players. They are also involved in the approval of any new products and services that bank assurance agent may actually want to come up with to introduce to customers. So the insurance regulator plays a more active role in the bank assurance space in terms of bank assurance. So those are the two regulators that look at bank assurance in Uganda. It is important that both are actually present because their roles are actually different and specific. The central bank on the other side would look at things like money laundering and adherence to other aspects of the Financial Institutions Act. So I feel that their dual regulation is actually important and very beneficial both to the customer and to the different players in the bank assurance space. So that, in a nutshell, is in it from me. My closing remarks, I would like to sincerely thank the Insurance Training College for this opportunity, and to also thank the participants who have really dedicated their time and to actually be able to log in and listen to all this material that we have actually been able to put together and share with them. I know time has been a hindrance, but these are baby steps, and as we go forward, I know that we'll actually do much, much better. Thank you very much. I submit.
Thank you. Over to you, Mr. Bashabe. Ronnie, you need to allow Mr. Bashabe to come in. We're trying to move as fast as we can. Proceed, Mr. Bashabe.
Yes, my question was, which non-compulsory general insurance policy is most commonly purchased in Uganda and why? Non-compulsory general insurance policy. I can say the most non-compulsory general insurance purchased in Uganda is motor comprehensive insurance. Motor comprehensive insurance, and the reason why this the most common purchased one, I believe most people think this is where the risk is, because when you tell someone to insure his house or his building, will say how many buildings in Kampala burn in a year. So what are the chances that my building is the one which is going to burn. But with a car, they know at any one time an accident can happen. When an accident happens, definitely there is that fear that his or her car is going to be damaged, or his car may cause accidents to other third parties, and he has to take care of those third parties in terms of, say, property damage or bodily injury. So because of that, people in most cases run to insure their cars as opposed to other properties. So basically, the most common non-compulsory general insurance is motor comprehensive. And actually, when you look at the figures, I don't know whether the figures have changed, but motor comprehensive, motor business was contributing the highest numbers in terms of premiums underwritten within the industry. So my concluding remark, basically, I want to thank the college for thinking ahead and coming up with this initiative. In these COVID-19 times, this is the only way to go, because now we are not sure when the schools are when schools are opening. So we believe this is the best way to go. And I also thank the participants who are IT compliant and have been able to use this mode of learning. Thanks so much, and I wish you the best.
Thank you,
Mr. Bashabe.
Mr. Bashabe.
Joshua, please come in now and handle the aspect of investment of funds. And also remember the scenario around the limitation period, which you also need to assist us with in terms of a claim. Joshua, over to you.
Yeah, thank you. Thank you, Jonah. I'll dive straight because of time to the question. I think the first question asked is on the investment of how do insurance companies invest funds. And I just want to guide here that the investment of funds is actually guided by the Insurance Act. That is the Insurance Act of 2017. And particularly in that Act, Section 50, if you go and open the Act, Section 50 actually guides investments of the Act. But when you look at the Act later the authority release regulations of investments. And if you're able to download or check IRA website, we also have investment regulations. How it actually works is that for life companies, if you look at the investment guidelines, it's actually Section 8 as by the investment guidelines. What basically tells us is that for life companies are expected to invest up to a maximum of 30% in government securities, basically being treasury bonds or promissory notes by the central bank. And then also they're required to invest only up to a maximum of 35% into property, things to do with land and investments in property. So if you realize that makes 30 plus 30, that is 65%. So the regulator leaves the autonomy of the difference to the life company to see how it invests. But what they are trying to do here is that you as Mr. Batanda said earlier, we are now in a risk-based supervision. So the regulator is trying to prevent what you call concentration of assets into one segment. Now, if there's a claim, do companies have liquidity to invest? So that is what happens to the life companies. However, for general is a bit different. For general, the guidelines guide up to general is 25%, 25% into for general is 25% into land and only 20% into government securities. So the difference is left to the company to decide based on the investment policy. So that's the guidelines in terms of investments guided by the Act and then also by the regulator. What's basically important here is that we have also had players who sometimes want to invest. If, for example, the regulator guidelines say you can only invest, let me say, 25% into government securities. And if I wanted to put, let me say, 30%. So what the regulator does there is to charge a penalty to the company for the difference. How? By matching what you call a capital additional fee, just to ensure that companies have the capacity to carry on the risk that they do take on. So that is basically in terms of guidelines. Lastly, for the question which was raised in regard to the limitation of making a claim, For life companies, what is most important is that once a claim occurs, the first question which is always asked is when did the claim occur? But then 2, did the claim occur during the term of the policy? And number 3, was the policy in force? If it's a group life policy, for example, which runs for 1 year, from Jan to December, if a customer died during the year when the policy was in force, the policy will be paid. But if you died after the period ended and the policy was not in force, that will not be payable. The other part is that if you look at best practice we borrow here is especially UK. And we're guided so much by UK because of their experience. The only challenge here is, especially for the claims, what we call where we say disappearance has occurred. I'll give an example of the September 2011, the 9/11 attacks, for example. So many people died, and it's assumed even some have never been traced up to today. So in that way, the best practice is we give up to about 7 years where someone is presumed to be dead. If after 7 years we have looked for you and we cannot get you, the assumption is that that person is presumed dead. So another example I can give is like the tsunami, which washed away the oceans. So if you have such catastrophic events and we trace someone up to maximum of 7 years, we presume that you have disappeared. But in conclusion, what I just want to say is that for what is critical here is that when did the claim occur and was it during the term of the policy? I can give an example of a client who passed, like maybe say today, and did not even notify anyone about his policy. Possibly could have told his lawyers, and lawyers will say maybe he told his lawyers to read his will after 3 years. So after 3 years, they come to read the will, and that's when they realize that he died. The life company will still pay the claim. Maybe my closing remarks is only to, in terms of conclusion, Jonah, is to say thank you to the Insurance Training College and also all other participants who have made this webinar very successful. Indeed, it's a good step. I think you're the first institution which is doing this. For mine, it's just a word of gratitude and to the leadership of ITC through Jonathan. The second one is also to thank our participants who have been available. I know there have been many things, but you've sacrificed, bought bundles. Please keep it up. That's the spirit. I also encourage the participants to read what we have shared, learn what we have shared, apply it. Don't leave the knowledge only for passing. Apply it to your work and make it different. And above all, take care of yourself, especially this period. I want to hand over. Thank you, and God bless you all. I submit.
Thank you, Joshua. Straight, I will dive into the next set of responses from Mr. Batanda, who is the final facilitator today. Mr. Batanda, Ronnie, can you please allow Mr. Batanda to come in? I hope the questions are clear.
Thank you. Thank you, Jonan. Thank you, everyone. Very quickly. We've been given a case where someone has probably knocked a motorcycle that was probably in the wrong in regards to how our third-party claims are treated. Generally, liability claims are quite complex in the sense that they're driven by a number of factors. There's one that we could look at, for instance, that is based on negligence. The other could be based on strict liability. So generally speaking, there is no one route that we usually adopt, but typically most insurance policies will say that it is the insured to prove their loss. You understand? But in circumstances where there is outright probably negligence, probably by a third party, insurers may be able to, what you'd say, fight a little bit harder to have these claims paid. However, I stand to be corrected by the legal experts. In regard to strict liability, usually those are quite straightforward. You're required to pay. However, at the end of the day, these two parameters will vary because someone then may actually ask, so if I'm traveling in a taxi, automatically you're a third party and the taxi was involved in an accident. Wouldn't I get compensation from the insurance company? I would say absolutely right. Yes, you deserve to get paid. But what if it was found that the driver was intoxicated? Would that invalidate the claim in any way? You understand? So there's a very thin line, and it requires a lot of legal mindset and legal technicalities to understand between the issues of negligence, and also strict liability. And I think it will vary. And in terms of the period in which claims can be lodged in, typical insurance policies will ask for you to notify claims within 17 days, 14 days, 30 days. There are specific policies like GPA policies that say that, for instance, if someone is not seen or has disappeared after 12 months, you can be able to lodge in a claim. So what you need to always find out is that how long would it take for you to notify your claim? Some insurance policies allow for what we call an extended reporting period for claims, which you can ask for, but sometimes it's an additional cost, which would then require you to say, you know what, can I report claims post expire of the policy, maybe 6 months? They call it the extended reporting period, ERP, but probably this will come at an additional cost. So all they'll be free of charge. So in terms of that period, it varies a lot, but it's the onus of both the intermediary and the client to understand the limitations required when they can actually be able to lodge in their claims. Then as a quick summary, I'm very grateful, of course, like my colleagues, for the team at the ITC, for giving us this opportunity, and also for leading in this new area of innovation to be able to transfer knowledge. I do encourage members to continuously engage on this forum, but also engage on different topics online, because they're all available. At the end of the day, it's about knowledge sharing. So I'd want to wish everyone a good day ahead and a good week. Thank you very much. I submit.
Thank you so much, Ronnie. Thank you so much to all our facilitators, and thank you so much to our participants. I don't think I have anything else to add. I mean, you've been here from last week. I want to see you even tomorrow, because we have the final session, which is the one on engineering. So our final session during this lockdown is tomorrow between 10 to 11. Please join us. The password and the ID have all been shared. Thank you so much to the team that has been behind this, ITC team, our technical team, our facilitators, management. We want to wish you all the best, and we look forward to the presidential address this evening. We anticipate that all will be well, and we believe that we'll see you soon at the college. So thank you so much. I've been John Antisache from Wakiso here, signing off.